Where does your money actually go the second it lands in your account? You picture it sitting safely in a vault with your name on it? It doesn't. Within hours, most of it is gone, loaned out to a stranger, and the moment you see how that works, you'll realize who's really getting paid here. Here's the part nobody explains. A bank doesn't store your deposit, it lends it. You put in $1,000, the bank keeps a small slice in reserve and pushes the rest out the door as a mortgage, a car loan, a credit card balance. Your savings become someone else's debt. You're not really a customer, you're the bank's cheapest source of funding. Now watch the trick. The bank pays you almost nothing to hold your money, a fraction of 1%. Then it lends that exact same money out at 7%, 15, sometimes over 20 on a credit card. It doesn't earn the high rate, it earns the gap. That gap has a name, the spread. Put real numbers on it. Leave $1,000 in a typical big bank account for a year and you might earn $5. That same 1,000 lent back out earns the bank around 65. You took all the risk of handing it over and walked away with $1 for every 13 the bank made on your money. And the spread is only engine number one. Engine number two is fees, and these are nearly pure profit. An overdraft when you slip below zero. A monthly maintenance charge for the privilege of an account. A few dollars every time you use the wrong cash machine. Quietly, these add up to a second income stream paid almost entirely by the people who can least afford it. So a bank really runs on two engines, both fueled by you. The spread quietly skims the difference between what it pays you and what it charges everyone else. The fees punish the moments you slip. Neither shows up as a line item on your statement, which is exactly why it works so well. Ever wonder how the bank affords the tower downtown, the stadium with its name on it, the ads everywhere you look? You're looking at the spread and the fees made solid. None of it was built on the 0.5% they pay you. It was built on the gap. Here's how you stop funding it for free. Move idle cash to a high-yield account. Many pay 10 to 20 times what a big bank does. Choose a no-fee account so overdraft and maintenance charges simply can't fire. Park larger savings in short-term government bills or a money market fund where you lend to safer borrowers and pocket the spread yourself. And keep only spending money in checking. Every idle dollar there is an interest-free loan you're handing the bank. So here's the reframe. You're not just a customer holding an account. You're a lender quietly financing the bank at almost zero. The moment you treat your cash like the asset it is, the spread starts working for you instead of against you. Same money, opposite side of the table. Remember the mechanics. Your deposit doesn't sit still, it's loaned out, and the bank lives on the spread between what it pays you and what it charges everyone else, topped up by fees on your worst days. Move idle cash to high yield, kill the fees, and lend it yourself through bills or a money fund, and keep the gap that used to build their tower.